Have you ever wondered what happens right before a financial storm? In 2024, the stock market reached dizzying heights. Investors were ecstatic, celebrating significant gains in major companies. The atmosphere was electric, filled with euphoria as record prices seemed to dance in front of their eyes. But, as history teaches us, peaks can often precede plunges. Whispers of instability were lurking beneath this shiny surface, waiting for the right moment to burst the bubble of optimism. Before we continue, make sure to subscribe to our channel and hit the notification bell so you don't miss our upcoming content that can transform your financial mindset. Now let's continue. Imagine walking through a bustling marketplace where every stall beams with success. That was the stock market in 2024. Major companies were thriving, and investors couldn't buy in fast enough. It was a classic display of herd mentality. But, while the excitement unfolded, some seasoned investors felt a twinge of caution. They saw beyond the glittering figures, recognizing that such surges can't last forever. The thrill of gains often blinds many to the realities that lie ahead, a danger every investor should heed. Reflecting on this, it's crucial to remember that in every significant market peak lies the potential for a collapse. Just like a high tide can be followed by a low one, market highs can lead to downturns. This phenomenon is not just a characteristic of the market, but a lesson in patience and awareness. As we celebrate successes, we must also remain vigilant and prepared for the changes that might come sweeping in. Taking a step back to analyze the market dynamics can lead us to make wiser investment choices. Warren Buffett, a name synonymous with wise investing, exemplifies the power of foresight in the financial world. While many investors were basking in the glow of rising stock prices, Buffett was strategically preparing for an inevitable market downturn. His keen insights and analytical mindset allowed him to position himself advantageously, avoiding the pitfalls that ensnared less cautious investors. In a landscape dominated by euphoria, he maintained a pragmatic perspective, grounding his decisions in historical trends and economic fundamentals. When others were enraptured by optimism, Buffett was quietly assessing the signs. He understood that markets operate in cycles, and the highs often contain the seeds of their own decline. By preparing for the collapse, he wasn't just reacting, he was orchestrating a master strategy. His actions were deliberate. Each move was calculated, aiming not only to safeguard his investments, but to seize new opportunities that would arise from the chaos. This deliberate approach speaks volumes about the importance of adaptability in investing. Buffett teaches us that even in times of exuberance, one should stay rooted in reality. Having the insight to plan for downturns gives one an edge, transforming challenges into opportunities. As seasoned investors know, preparation is not just a tactic, it's a mindset. By learning from Buffett's strategies, we can cultivate our own awareness, navigating with confidence even when the market seems overwhelming. Warren Buffett possesses an exceptional ability to identify signals that often evade the attention of the average investor. In the midst of soaring stock prices, he discerned subtle yet crucial indicators of an impending market crisis. These signs were not just fleeting anomalies, they were patterns woven into the fabric of market behavior. While others were entangled in their optimistic outlook, Buffett's analytical mind was busy dissecting broader economic trends that hinted at vulnerabilities looming on the horizon. Every seasoned investor should take a page from Buffett's playbook by closely observing market dynamics. He viewed rising debt levels and inflated asset prices as red flags, warning signs that most overlooked. From his perspective, investor euphoria masked underlying issues. Indicators such as declining consumer confidence and increased volatility pointed to instability waiting to unfold. These insights allowed Buffett to arm himself with knowledge that would guide his decisions in the turbulent times ahead. Recognizing the signals is not merely an act of vigilance. It's a skill honed through experience and education. Buffett's ability to connect the dots sets him apart in the investment realm. It compels us to shift our focus from immediate gains to potential threats facing the market. By developing a keen eye for trends and heeding warnings that others might dismiss, we can embark on our financial journeys with a sense of preparedness. Learning to recognize these signals is essential for navigating the complexities of investing, ensuring we remain vigilant even when the tide seems to be in our favor. In the face of an unpredictable market, Warren Buffett executed a strategic sell-off starting in late 2022, He understood that proactive measures were essential to safeguard his investments amid rising uncertainty. Rather than cling to shaky positions, Buffett opted to divest major shares with a deliberate approach, ensuring he could pivot effectively as conditions shifted. This was not a decision made in haste. It was grounded in meticulous analysis and foresight, emblematic of his long-term investment philosophy. Buffett's sell-off strategy was about more than just offloading shares. It represented a calculated response to the market's unstable climate. Each decision to sell was guided by an understanding of which sectors faced potential declines and which held promise for stability. His foresight allowed him to release assets that could bleed value while paving the way for future investments in more resilient areas. This approach demonstrated the importance of flexibility and adaptability during turbulent times in the financial landscape. Such strategic foresight is a testament to Buffett's mastery of market dynamics. By divesting strategically, he not only protected his portfolio, but positioned himself favorably for what lay ahead. This proactive stance is a crucial lesson for every investor. Understanding when to sell is as important as knowing when to buy. Embracing a forward-thinking mindset allows us to respond to changes effectively, turning potential losses into learning opportunities. As we navigate our investment paths, let's remember the value of strategic decisions in the pursuit of long-term success. Warren Buffett exemplifies the power of patience in the face of market volatility, demonstrating the value of waiting for the right moment to sell. Unlike many investors who succumb to panic during downturns, Buffett approached his sell-offs with a level-headed strategy. He understood that emotional reactions can cloud judgment and lead to hasty decisions. By maintaining his composure and watching market signals closely, he was able to execute significant sales at strategic times, maximizing his profit potential. Buffett's disciplined investment strategy stands in stark contrast to the reactive behavior often seen in tumultuous markets. He recognizes that the art of selling is just as important as the art of buying. Instead of following the crowd, he waits for opportunities that align with his analysis and intuition. This means that each sell-off is not merely a response to market pressures, but a calculated maneuver aimed at maintaining the integrity of his portfolio and ensuring long-term gains. This approach underlines a fundamental truth about investing. Patience is a virtue that pays dividends. By prioritizing strategic timing over impulsive actions, Buffett demonstrates that success in investing requires more than just knowledge. It requires emotional control and foresight. As we reflect on his methods, we should embrace the lessons of patience in our own investing journeys. Cultivating a measured approach enables us to navigate the complexities of the market with confidence, ultimately leading to greater rewards. Warren Buffett is renowned for his ability to invest against the grain, making decisions that often challenge conventional investor behavior. A prime example occurred when he chose to sell his shares in Apple, a company many viewed as a perpetual growth engine. This bold move was informed by his deep understanding of market bubbles and overvaluation, key concepts that separate successful investors from the crowd. While others clung to the excitement surrounding tech stocks, Buffett recognized the risks hidden within inflated valuations. This contrarian mindset showcases Buffett's commitment to fundamental analysis over trendy speculation. He isn't swayed by popular opinion. Instead, he evaluates the intrinsic value of an asset. By selling Apple shares at what he perceived to be a peak, Buffett demonstrated a clear awareness of market dynamics. This decision was not a reflection of his belief in the company's potential, but rather an acknowledgement of the unsustainable rise in its stock price. Such insights allow him to navigate the market more effectively, often leading him to profitable outcomes where others falter. Investing against the grain requires a strong conviction and the ability to think independently. Buffett's choices remind us that sometimes it's essential to step back and assess the bigger picture, rather than getting swept up in the hype. By adopting a mindset that values analytical thinking and embraces rational decision-making, we can learn to identify risks and opportunities that others might overlook. Ultimately, this approach fosters a deeper understanding of investments, guiding us toward more informed decisions and better financial outcomes. Amidst selling off major shares, Warren Buffett adeptly identified new opportunities, strategically reinvesting in sectors that showed resilience. His keen ability to recognize where consistent consumer demand lies allowed him to pivot effectively during uncertain market conditions. By redirecting funds into industries such as alcoholic beverages and energy, Buffett showcased a future-oriented vision, betting on sectors that could weather economic fluctuations and provide steady returns despite market instability. These strategic reinvestments highlight Buffett's understanding of consumer behavior and market trends. He does not simply react to sell-offs. He looks towards the future and seeks out industries that have a reliable track record of demand. For instance, companies in the beverage and energy sectors often maintain strong consumer bases, making them less susceptible to downturns. By investing in these sectors, Buffett positions himself to capture growth trajectories that others might overlook in favor of more glamorous but riskier ventures. This practice of identifying new opportunities amidst uncertainty is a valuable lesson for all investors. It encourages us to remain vigilant and open-minded, even when market sentiment is negative. By focusing on sectors with enduring demand, we can minimize risks while maximizing potential on our investments. Buffett teaches us that while selling may be necessary at times, reinvesting with intention can lead to fruitful outcomes. Embracing an adaptive strategy empowers us to navigate the complexities of the market and seize opportunities where they arise. The Buffett indicator is a pivotal market valuation metric that serves as a guiding compass for his investment decisions. This indicator compares the total market capitalization of U.S. stocks to the country's gross domestic product, GDP, providing a clear insight into market valuation. When the indicator signals that the market is overvalued, it raises alarms for prudent investors, suggesting it might be time to tread carefully or reassess positions. Buffett has often used this tool to reinforce his disciplined investment strategy and maintain a rational perspective in volatile environments. This metric is not merely a number. It embodies the essence of Buffett's investment philosophy rooted in value and sustainability. By using the Buffett indicator, he illustrates a commitment to identifying whether the market's exuberance is justified. High readings imply that stock prices may be inflated relative to the fundamental economic output, indicating a potential bubble. Understanding this allows investors to act with foresight and caution, avoiding common pitfalls associated with herd mentality in the financial market. Embracing the Buffett indicator as part of our investment toolkit empowers us to make informed decisions based on comprehensive analysis rather than fleeting trends. It encourages a mindset of awareness regarding market conditions and valuations. By learning to interpret similar metrics, we can develop a more disciplined approach to investing, which ultimately helps us navigate market fluctuations with wisdom. This creates a bridge to informed decision-making, allowing us to protect our investments and seize opportunities when the market presents them. Warren Buffett's insights into the market's future reveal a sobering reality. The current crisis is far from over. He foresees ongoing financial instability and downturns potentially affecting several key economic sectors. By refusing to sugarcoat the situation, Buffett encourages investors to adopt a mentality of preparedness, emphasizing the importance of understanding that adversity can emerge even after periods of apparent recovery. This perspective is a reminder that vigilance and adaptability are essential in the investment landscape. Buffett's warnings are not simply pessimistic predictions. They are a call to action for investors to reassess their strategies and reinforce their defensive positions. He highlights sectors that may continue to struggle under economic pressure, advising caution in investment choices. This proactive mindset champions the idea that, while it's tempting to chase after trends, being grounded in reality can help preserve capital and position portfolios for future success in times of uncertainty. Preparing for the market's future ultimately invites us to embrace a more resilient investment philosophy. By acknowledging the likelihood of further downturns, we can better shield ourselves from the ramifications of unexpected market shifts. Buffett's wisdom impresses upon us the necessity of staying informed, adaptable, and strategic in our investment choices. Cultivating this mindset not only enhances our ability to weather storms, but also equips us to identify opportunities that may arise in the wake of adversity, allowing us to thrive in the long run. Renowned economists are increasingly echoing Warren Buffett's concerns about the financial landscape, predicting a looming global financial crisis driven by escalating debt levels and widespread economic instability. Their analyses align with Buffett's cautious outlook, emphasizing that the shadows of unsustainable debt can lead to significant market disruptions. This consensus among experts highlights the urgent need for both individuals and institutions to reconsider their financial strategies in light of these potential challenges. These economic experts delve into various factors contributing to this precarious situation, such as rising inflation, volatile interest rates, and the pervasive nature of consumer and corporate debt. Their warnings serve as a clarion call for investors to stay informed and prepared, as the interconnectedness of global markets means that issues in one economy can swiftly ripple outwards. This shared concern underlines the importance of maintaining a vigilant stance in an era marked by uncertainty and rapid change. By heeding the insights from these economists, investors can better equip themselves to navigate the turbulent waters ahead. An informed approach involves not only understanding the market dynamics at play, but also actively seeking ways to mitigate risks associated with an impending downturn. Engaging with expert analysis prompts us to reflect on our financial habits and assumptions, fostering a mindset of preparedness. Ultimately, collaborating on these insights can enhance our resilience and adaptability in facing whatever challenges the economic future may hold. Warren Buffett's investment philosophy is a treasure trove of invaluable lessons, emphasizing the critical role of patience in achieving financial success. He advocates for a thorough analysis of any investment opportunity, believing that understanding the fundamentals is key to making wise decisions. Buffett's approach stresses that quick gains often come at high risks, and it is through diligent research and careful consideration that we can navigate the complexities of today's market effectively. At the heart of Buffett's strategy lies the concept of defensive investing. This means prioritizing stability and long-term growth over speculative quick wins. By focusing on companies with solid fundamentals and a proven track record, investors can shield themselves from market volatility. This defensive positioning allows for a more secure investment environment, enabling individuals to withstand economic upheavals without succumbing to panic or hasty decisions. Incorporating Buffett's fundamental lessons into our own investment practices fosters a disciplined and resilient mindset. By valuing patience, rigorous analysis, and a defensive strategy, we can better safeguard our financial futures. These principles remind us that investing is not merely a pursuit of profit but a calculated journey that demands focus and endurance. Embracing Buffett's philosophy allows us to approach the market with confidence and clarity, ensuring we remain steadfast even amidst uncertainty. This analysis serves as a powerful call to action for all investors to embrace Warren Buffett's principles of strategic investing. Adopting these principles is essential in navigating the complexities of today's unpredictable market landscape. By remaining informed and vigilant, investors can better prepare themselves for the shifting conditions that are bound to affect their portfolios. Recognizing the importance of thorough research and disciplined strategies promotes a more resilient financial approach. Furthermore, embracing Buffett's investment philosophy encourages us to cultivate a long-term perspective, focusing on value rather than short-term gains. This mindset shift empowers investors to act from a place of knowledge and confidence, equipping them to make informed decisions. As we continually educate ourselves about market trends and economic indicators, we enhance our ability to anticipate potential risks and opportunities, allowing us to adapt smartly to changing circumstances. Ultimately, the essence of strategic investing lies in the commitment to continuous learning and awareness. By integrating Buffett's insights into our investment strategies, we can build a more robust financial foundation. This proactive approach not only helps safeguard our investments, but also positions us to thrive amid uncertainty. Let us take these lessons to heart and strive for excellence in our investing journeys, creating pathways toward lasting financial success.